All right, let's cut right through the noise today. There are two massive fears dominating just about every market conversation right now. Is the stock market rally officially over? And is the US about to walk off a debt cliff? We're going to dig into the actual data and see what's really going on behind the headlines. So here's our game plan. We'll kick things off with those two big questions everyone's asking. Then we'll get into separating the market noise from the real signals. After that, we're going to take a close look at US debt, see what the liquidity indicators are telling us, and wrap up with a peek at a pretty controversial new tax idea that's bubbling up in Europe. Okay, so first things first, let's just lay out the two questions that seem to be keeping investors up at night at this very moment. Number one is all about momentum. After some pretty wild swings lately, everyone's wondering, is the optimism that's been pushing stocks up still warranted, or is this rally finally running out of steam? And then there's the big one, right? The fear you hear everywhere. This idea that the mountain of US government debt is about to trigger some kind of massive crisis. So, to even begin to answer that first question about the rally, we've got to do something that's absolutely crucial. Separate the real market drivers from all the distracting noise. Now, on the one hand, you had all the geopolitical headlines causing a ton of short-term jitters. That was the noise. But the real signal, the thing that was actually moving the needle for global markets, it was the stabilization of the Japanese bond market. This is a detail that's so easy to miss, but when the world's third largest economy has its bonds on solid ground, it calms everything down. And here's why that stabilization happened. Major Japanese banks started buying their own government's bonds again. That simple act dramatically lowered the risk of some kind of crisis spreading from Japan to the rest of the world. It was a huge stabilizing force for the markets. Okay, so with that short-term fear kind of put to bed, let's tackle the monster under the bed, this pervasive narrative of an impending US debt crisis. The story almost always kicks off with this number, $38 trillion. It's a massive, intimidating figure, and it's the foundation of all the anxiety. It's designed to grab your attention, and let's be honest, it does a pretty good job. But the second you look at what that debt is actually made of, the story changes completely. If we look at the debt that's maturing in 2026, about 75% of it isn't long-term bonds. It's short-term treasury bills. And this is the critical point. T-bills are basically like cash. They're super short-term, super liquid, and financing the government with them is specifically designed to avoid sucking liquidity out of the financial system. Rolling this kind of debt over is just way less disruptive. So the next question is obvious. Who's going to buy all this debt? Well, if you look at recent bond auctions, demand has been really strong. Plus, we're on the verge of new technologies like tokenization coming in 2026, which is just a fancy way of saying they'll create digital versions of bonds. And that's expected to open up the floodgates to even more buyers. So instead of getting caught up in these fear-based narratives, let's just look at the dashboard. What are the key market indicators telling us about liquidity? The lifeblood of the market right now. Well, if a real crisis was on the horizon, the risk premium on corporate bonds, that's the extra bit of interest investors demand to hold them, it would be skyrocketing. But look, it's doing the exact opposite. It's in a clear downtrend, hitting new lows. That's a sign of confidence, not fear. It's a similar story with the stock market's own fear gauge, the VIX index. Yeah, it had a little spike, but it's fallen right back down to low levels. The signal's calm, not panic. And it's not just stocks. Volatility in the incredibly important bond market, which we measure with the MOVE index, has also backed off significantly from its recent highs. So you put all these pieces together, and what do you get? The data is telling us that liquidity conditions are good, and when liquidity is expanding, it's just really, really hard to justify a persistently bearish view based on the actual evidence. Okay, now that we've really examined the data behind that whole debt narrative, let's pivot to a totally different kind of risk. This one is a new policy proposal coming out of Europe, and it could have some pretty big implications for investors everywhere. Get this, the plan is to tax the rising value of your assets before you even sell them. This is a fundamental change from how capital gains have always been taxed, and you can bet a lot of people are watching this very, very closely. The big concern here is what they call a slippery slope, the policy to start off by targeting a small group, say crypto and stock investors. But then, once it's in place, it could easily be expanded to include things like real estate, which would suddenly affect a much larger group of people. And here's the really wild part. The whole thing is asymmetrical.
The government gets to tax your paper gains every single year. But if your asset value goes down, oh, you don't get a refund. You just get a little credit you might be able to use against future gains. So the government shares in the upside, but you take all the downside risk.
And this all leads to a much bigger, more provocative question. What's the ultimate goal of these increasingly complex financial and tax policies? The real takeaway from all of this is that you have to look past the scary headlines, whether they're about market fears or new policies, and really focus on the data and the mechanics behind them, because that's where the real story always is.